Hello, my name is Michael Clements, and I am the Managing Director of Synergy Research Services, which provides investment opinions and a model portfolio of 50 companies that we've chosen from the biggest, best, most resilient, profitable, and growing companies around the world. This is the 8th of a series of informative videos that we have created for investors, and its purpose is to acquaint you with other aspects of dividend and growth investing. I'm going to show you 3 graphs that will help explain why investing in dividend-paying companies can provide a powerful uplift to your portfolio. The first graph is the output of a study done by Ned Davis Research, and it shows how dividend growers and initiators perform the best over a 50-year period starting in 1972. Then at about 1/2 the performance level came dividend payers, which are presumably companies that didn't increase the dividend payments much or at all. Then at about 1/3 the performance level were the equal weight S&P 500 index. And no surprise, the worst performers were the companies that cut or eliminated their dividends, which saw more than a 96% reduction in total returns. The next graph from Morgan Stanley Research is a bit busy, but the story it tells is that in the long run of 10 years or more, total returns are driven primarily by revenue and profit growth, which makes sense intuitively anyway. In the short run of 1 year or so, these 2 factors are less important than the expansion of the price-earnings multiple and free cash flow growth. What this means is, in conjunction with the prior graph, that in the long run, companies that grow revenues and profits the most are also likely the ones that will increase dividends the most as well. The 2 graphs of metrics go hand in hand. The last graph, which was produced by JP Morgan Asset Management, covers time, diversification, and volatility of returns amongst 3 asset classes: stocks, bonds, and the classic 60-40 portfolio, which is comprised of 60% stocks and 40% bonds. As you can see from the graph, in the short to medium term, stocks are the most volatile, but when you move out to the 20-year rolling average, the lowest level of return is 6%, and the highest is 18%, with the average coming in at 11.4%. Bonds are less volatile than stocks, but in the long term, they perform the worst of the 3 options with a range of 1% to 11%, with an average return of 5.3%. Lastly, the 60-40 portfolio performed in the middle of the 3 options with a range of 5% to 15%, with an average return of 9.3%. This is certainly respectable, but you're clearly leaving money on the table with this approach to the tune of 2.1% per year compared to the stock-only portfolio. That may not sound like much, but when you look at the inset box of the growth of $100,000 over just a 20-year period, you get an extra 47% with an all-stock portfolio. But you have to suffer through a greater amount of volatility, which is why the 60-40 portfolio is so popular. To summarize what we just covered, at Synergy Research, we propose an all-stock portfolio made up primarily of dividend growers with the goal of greatly outperforming the market averages and alternative investments over the long run. So far, it's working. We're also great believers in wide diversification by country, by industry, and by industry sector. Our goal is to maintain a model portfolio of about 50 companies that are the biggest from all around the world, that are leaders in what they do. In this manner, we can sleep well at night knowing that even if 1 or 2 companies ever went to zero, at most they would compose about 2 to 4% of the total portfolio, basically a rounding error. Thank you for watching, and the next video segment will explain the top factors we consider when investing in companies.